The Fed indicating it's likely to ease interest rates if economic growth continues to falter. Robert McTeer is the former president of the Federal Reserve Bank of Dallas and the Secretary of Commerce, continues with us. How you doing, Bob? It's good to see you.
Good. Thanks, Joe.
Are you surprised at the continuing, I don't know, what is it, a lack of confidence, Bob, given all that we've done so far?
I'm surprised every day. I just leave my investments where they are, thinking I want to be in when the rebound comes, and I lose about 2% a day. I don't know. I haven't done the arithmetic to see how long that'll last.
Yeah.
But, sooner or later, it's got to come back. Yeah,
and I don't think if it's 2% a day, you never go to actually zero, do you? That's like an asymptote, isn't it? It gets...
you reach it asymptotically, as you just said.
Yeah, but it's not a good thing, obviously. And after 50 days, things are not looking as good as they were prior to that. What else can policymakers do? The Fed? Anybody, Bob? The president? What do we need?
You may recall that when the Fed started easing, it surprised everyone by cutting the discount rate first, which cut the differential in half. Along the way, they cut the differential another quarter point. So one thing they might consider is lowering the discount rate maybe 50 basis points and the Fed funds rate only 25 to get the money that's going out through the auction facilities and discount window borrowing a little cheaper.
So that would be
and
at a half,
I don't see anything wrong with the... Pardon?
That would leave a half different?
That would leave a quarter in the other direction.
Okay. I got it.
Yeah. And then it may not help a lot, but I think they ought to consider reducing margin requirements for stock purchases and possibly lowering reserve requirements just a little bit. Although I think bank capital is more of a constraint on lending than bank reserves, which brings us to my favorite topic, which is mark-to-market accounting. I still think we need relief there and that it would do a whole lot of good, and maybe your guest host could use his good offices in some of these intergovernmental councils to push that idea a little bit.
Well, I used to, in business, I used to be always a little bit suspicious when people would say we've got to fix the business by changing the accounting rules. But I know it's an idea that's been coming up quite a bit recently.
I just vaguely recall when they put mark-to-market in and it was being debated, and Alan Greenspan was against putting it in the first place. And I don't recall all the reasons, but the point is, it's not the 13th commandment. I mean, the idea of all these banks that are going to fail, not because they've lost money, but because they have had to write down some assets to almost zero, that will eventually come back up, and they would be able to hold them until they come back up. It just seems like we're self-inflicting pain. Also, when a bundle of something is impaired, why do you have to take the hit on the whole bundle when you could just take the hit on the impaired part? There are a lot of things the accountants could do if they would be a little bit less rigid, because this is a national emergency.
Yeah, and it's certainly easier than spending $1 trillion while you're at it.
Exactly. Yeah. Well, and also on the bailout thing, I don't see the point in leaving the other $350 billion for the next administration. That would be fine, but the next administration is a couple of months away, and all this stuff needs to be done ASAP.
Well, I can tell you it's moving very quickly, and it's been over $150 billion, 30 banks. So that $350 billion will be invested very, very quickly. And that's what the history has shown us over the last couple of weeks.
What would be the...
They've been doing a good job. I just think they ought to do more of it now rather than save it for later.
All right, Bob. We'll have you back hopefully soon for a longer discussion as guest host next time you're on the East Coast, of course. But it was good seeing you this morning.
Okay, thanks, Joe.
Okay.